Hello traders everywhere, Adam Hewison here, co-founder of MarketClub with your 1 p.m. market update for Friday, the 5th of August. Wow, this has been quite a week, but ladies and gentlemen, the market action yesterday was real. Please be aware that we have started on a bear market. As you have pointed out in previous updates, we were looking for the move to the downside, and that has now happened with all of our indicators firmly entrenched in a bear mode. Most people don't remember, who are not in the 60s, certainly don't remember the bear markets in the 70s. It caused tremendous amount of pain to investors. It seems that we've just kicked the can down the road for the last time. We're finally bringing common sense back into the market. So let's take a look. If you want to read the rest of my comments, I won't bore you with them right now, but you can read them on our blog. Got some very strong things to say about the country and what we think should happen. Let's go to our first market, which is the S&P 500. And as you can see, we're up a little bit on the day right now, but let me explain, this is a very volatile session, and we may have just seen the bottom, at least for the moment. But let's take a look at, take this out a little further. And what I want to throw in here is our Fibonacci retracement. This is what we're looking for in the market. So we click on the Fibonacci tool here. We click on the very highest point. Oh, that's not the one. Hold on. Take that off. Click on the Fibonacci tool, we stretch it down to this low point here, and you can see we've touched the 50% retracement level from the lows seen in July. That's July of last year, and we may see a little bit of a pull up, but eventually this market looks like it wants to go still lower to me. Certainly the 1148 level is a key level in this market. As you know, we pointed out, and I'll put our indicators on the screen, the telestrator on the screen right now. As you can see, we were pointing this out earlier, and that is the, just clear that off the screen for a second. As you can see, we've talked about these three mountain tops, or a head and shoulders top, which is pretty much right here. And let me draw that in. A couple of things. One is the head and shoulders formation here. We pointed that out 2 or 3 weeks ago. And there's the neckline right there. And also the space between here and here is about 50 days. And the space between here and here is 50 days. We pointed this all out on our previous reports. Not a big deal there. But the neckline takes you right around here, so we've pretty much gotten very close to a target zone for the neckline. For the moment, I think the 61.8% retracement, which takes it 1148, is definitely potentially there in the target. This market is just not going to suddenly turn up and go up like this. It just isn't going to happen. I think we may see a little bit of a bobble, and then I think we'll see a further downward slide in this market. Things just aren't as good as we think they would like to think they are. But generally speaking, the trend, certainly with all of our indicators, monthly, weekly, and daily negative, -90, is not a good sign for this market. This is the S&P 500 daily chart. We're looking at a candlestick chart going back to May of 2010. And again, this is something to certainly look at. And if we take everything off the screen and go to a, let's say, a 5-year contract, or 5-year view, I should say, not contract, and you can see, even though a couple of things, let me just take some of these triangles off, get a clearer picture, but you can simply draw a trend line. We did this before, from here, and you can see this is a very, very important trend line. This is a trend line that goes back all the way to March of 2009, which was the low we saw. And you can see that that trend line is definitely something that you should we brought it to your attention. It's something very important. We could certainly see this market go down to 1,000 without too much of a problem. And potentially, and this is the real concern that I have, is if we, let me put the telestrator on. If we take this period right here, and the move down here, the measurement, let's say down to 700 and we're around 1700 here. So if you take 1,000 points from here, it would say we're going to go down to maybe 400 or 500 on the downside, and that would be really catastrophic for a lot of businesses and a lot of companies and a lot of people. So let's hope that doesn't happen, but the reality is the trend right now in the S&P 500 is down. I would trade it accordingly on any kind of ups. On Wednesday we talked about inverse ETFs. You could have easily gotten those on at much better levels. They've proven to be very, very profitable. So let's stay with those. Let's take everything off the screen, go to our next market. And the next market we're going to be looking at is kind of interesting. It's going to be silver, or actually gold in this case, but let me get a closer look in. But this is interesting because we're seeing a couple of things we haven't seen before in gold. And that is, one is we've got this move. This is a daily chart. And I'll just go a little closer. So we have a daily chart. This is the high yesterday. We traded around 16 up to 1680. But this closed lower, a new high. You've got a bearish engulfing line. If the market closes lower today, I think this is going to be a top in the gold market for a while. Now, a lot of people probably don't want to hear that, but that's the reality of this particular formation. It's a negative engulfing line. Engulf is the previous day's action, red. If it closes lower today, another red bar, it confirms this, and we would expect to see the market come down and possibly test the 1620 level, even 1600 level. Let's see how that plays out. But similar picture in, actually not a bit, a more negative picture is actually in the silver market, which has actually fell to its lowest level since early, about mid-July. And that's still looking a little bit rolling over to the downside, but let's just do a little, you'll see where we are in here. But there again, we could look at this market and it's over its 200-day moving average. We can put a Fibonacci retracement level, go from the top here down to the lows here, and you can see it looks like, let's see, hold on. Yeah, that's better. Let's get a better picture of the view. Looks like we can get down to maybe 3650, which would be a 62% retracement, 61.8 to be exact, and that would be a good place to maybe look to buy some silver. But for the moment, it looks a little bit on the defensive, as does gold. So next market is going to be the crude oil. Crude oil, very similar picture to the S&P 500. A lot of pressure earlier on. Came back up. It looks like it's about unchanged. I think probably for the moment we may have put a low in for this market. If we put the other indicator we've talked about before, which we use quite often here, and that is our, okay, hold on, the Donchian channels. And there they are. So you can see we're out of the Donchian channels, and if we go, let me just take this off. If we go down further, you can see this market is very heavily oversold. Similar to this period here, I would expect we'll maybe do a couple of days and maybe see some sort of recovery. But for the most part, the trend in crude oil with our trade triangles, you can see quite clearly. Monthly from 95.85, it's 86 right now, so it's down quite a bit. 94 on the weekly, 93, so profits all around on this market, which has done very, very well for us. So again, following the trade triangles, you're going to do well and you will make money trading with this technology. So let's go to our next market, and that's the dollar index. And again, as we said, I think you have a similar situation here. Let's scope this in just a little bit further. And let's take our Fibonacci tool again. I use the Fibonacci tool a great many times during these sessions, so it's really a powerful tool for you to learn. And I'm going to go from the top here, stretch it down to the lows, and you can see this market reversed exactly from the Fibonacci number of 75.50. So again, this is a very important element in this market. It's below its 200-day moving average. There's the 200-day moving average you can see on the screen right there. And also, it's a mixed picture, 65, a trading range. So chances are this will be what is considered to be a dark cloud cover, meaning that it's half of or two-thirds of this particular bar will cover this bar, meaning we probably put a top in the dollar, at least for the time being. So very, very interesting markets. Let's go to our last market, and that's going to be the CRB index. And again, this market is way out of its Donchian trading channel, It is very heavily oversold, which you can see very similar to these periods like here. Not to say it can't go lower, but this is usually these markets come out of these periods and rally and come back inside the Donchian trading channel. So I would assume, given the fact that this market's down here, oversold, the fact that we're out of the trading channel, I think we'll probably see some recovery back up into the trading channel next week. So this is going to be a very, very interesting week. The markets have done some extraordinary things. A lot of wealth has been changed around in a very short period of time, which is always a challenge. But if you look at our markets now, we're actually now up on the S&P 500. So we may have, it looks like this is going to prove to be a bottom. At least a temporary bottom. We've done the retracement levels, you know where they are, but we have broken that long-term trend line, which is negative, and also all of our indicators are negative on the S&P 500. Hey, this is Adam Hewison. Thanks for stopping by. And I think really, to give you some credit, you may want to give us a call at the number we talked about for the PMI. We've joined PMI, which is a coaching thing. This is a really good thing to have right now. I'll put the number on the screen. I'll write it on the screen for you. And the number to call to get a personal coaching from MarketClub is right here. Give us a call. So here's the number. Again, whoops, that's not what I want to do. So let me close that up and just give me 1 second. Let's take that off the screen, clear it up, and take that off. We try to cover a lot during these sessions, so I hope you just bear with me for 1 second. But here's the number you want to call, and basically it is 877 219 1482. Give them a call. I think they'll be able to help you, especially during these really volatile times. You know, personal one-on-one coaching is really rare in the financial world, and this is what we're offering: one-on-one coaching to help you get through these times, because you've got to protect your money. This is very, very important. So give us a call, 1-877-219-1482. Hey, this is Adam Hewison. Thanks so much. I'll talk to you soon. Every success in the marketplace.